Good afternoon, everyone. Today we're going to talk about gold. Gold's been pretty disappointing this year. After nearly a decade of steady rises, it's been stuck in a broad range over the last year. Recently, it hasn't even been able to recover the highs for the year set back in October, much less the record high set back in September of last year. Have we seen the end of the long gold rally, or is this just a consolidation phase before the next leg of the rally? Well, we're pessimistic about gold in the short term. With the dollar strengthening recently and the threat of a Eurozone breakup diminishing, we think gold is likely to have problems gaining further from here. In fact, we suggest that traders go short gold, as we think it's likely to move back towards the bottom of its trading range over the next few weeks. Longer term, we're bullish though, for reasons that we'll discuss later. Now, the gold price usually moves up when the dollar moves down, and the other way around too. Here's a graph of the relationship between the two so far this year on a weekly basis. We use the DXY index for the dollar. The DXY index measures the value of the dollar against several of the other major currencies. What this shows in this graph is that 2/3 of the time this year, the price of gold went down over the week and the value of the dollar went up. Our view on the dollar is that it's likely to weaken slightly from here versus the euro, since the euro is on a recovery trend, but we don't expect a major move for the rest of the year. Euro-dollar has had trouble breaking out of its recent trading range, and we expect it to remain boxed in for now. In particular, the possibility of an early end to the fiscal cliff talks should keep the dollar from weakening very much. So gold might get some support from the dollar for the rest of this year, but only some. And even that might go the other way. Well, the dollar could help to push gold up slightly, but another main factor supporting gold recently, fear of the Eurozone crisis, is likely to be less supportive than it has been. While problems keep cropping up and will keep cropping up, there's no doubt that the big fear of a collapse of the Eurozone is over for now. That means the need for a refuge from paper currencies as a whole has diminished a lot. To better understand what drives the gold price, we made a small mathematical model of the gold compared to the dollar's value, as measured by the DXY index, and the spread of European peripheral countries' bonds over German government bonds. That's a measure of the risk that people see of the Eurozone breaking up. In this graph, the blue line is the actual price of gold. The red line is the theoretical price that we determine with our little model based on the dollar and the bond spreads. What we found from doing this is that those two factors alone explain 87% of the movement in the gold price over the last 2 years. The model shows that, as we figured, the gold price does indeed tend to go up as the dollar weakens, but gold also tends to go down as the spread between the peripheral bonds and German bonds declines. In other words, as the risk of a Eurozone breakup diminishes. Given where spreads are now, our little model suggests that the current gold price would be appropriate for a dollar almost 3% weaker than today, or euro-dollar at around 134 or so, well above where we are now. Or looked at the other way, the model suggests a gold price of $1,660 would be more appropriate than today's level. Although, of course, please remember that the model is only a rough estimate of reality and can't capture all the factors that go into establishing the price. Now, given that the US seems to be headed towards an early resolution of the fiscal cliff, the Eurozone is not likely to fall apart anytime soon, the Chinese economy seems to be on a recovery trend, and energy prices have peaked, the risks in the world appear to have diminished for now. Given that there are fewer risks, or that the risks are getting smaller, we expect gold to decline too, in our view. So people with profits in gold might want to consider taking those profits and putting the money to work in what we think of as a more promising asset, such as buying euro-yen, or even buying the New Zealand dollar against the Swiss franc. People who trade the precious metal should think about trading from the short side for the time being, in our view. Of course, there are other factors that go into determining the gold price as well. One big factor is the US Fed's quantitative easing program, which has flooded the markets with liquidity and made people worry about the safety of paper money in general. You can see from this graph that the price of gold has followed the size of the Fed's balance sheet fairly closely for the last few years. In this graph, the red line is the price of gold, and the blue line is the Fed's balance sheet, the amount of assets that the Fed holds. In fact, one of the reasons why the gold rally may have stalled this year is that, as the graph shows, the Fed has actually been shrinking its balance sheet. The amount of assets it holds have been declining, which reduces the amount of money sloshing around in the system. So it's possible that as the Fed switches from Operation Twist to simply buying Treasury bonds outright and increasing the size of its balance sheet again, gold could get a boost. But I wonder if perhaps we haven't already seen that boost in the jump in prices that happened back in September, as people started anticipating such a move, and the increase in liquidity may already be factored in. We'll have to see. This could be a factor pushing gold up next year, or it could be already discounted in the market. Over the long term, though, we are bullish on gold for a very simple reason: more buyers than sellers. In particular, central banks. This graph shows that central banks were sellers of gold up until 2008. In this graph, the blue line is the amount of gold held by the central banks, and while the red line again is the gold price. And as you can see from the graph, since 2008, the central banks have started to buy back their positions. But as you can see, they've got a long ways to go before they're back to the level of gold holdings that they used to be. They were selling into the rally until a few years ago. Now they've turned net buyers. And they have a lot more reserves than they used to have, and much less of it in gold. We think they will continue to be buyers. And who's going to be selling to them? Private investors are also piling into gold, as shown by the record holdings of gold that they hold through exchange-traded funds. So, to sum it up, in the long term, gold seems like a buyer's market as central banks and private individuals compete for the limited amount of gold that's being mined around the world every year. But for the short term, we're not so sure. We think a stable dollar and diminishing Eurozone risk are likely to send the gold price down for the next several weeks. We recommend selling gold and putting the money to work in one of our favored currency pairs, such as euro-yen, buying the euro against the yen, or buying the New Zealand dollar against the Swiss franc. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you good trading.